Bid speed, the insight you need. In the opening hours of Asia trading on Monday, the US dollar index soared to a 20-year high, reaching 109.4. This comes after Federal Reserve Chair Jerome Powell signaled that interest rates would be kept higher to curb inflation. Other factors, including geopolitical tensions, also added to the dollar's strength. The US dollar's restless climb made a hole in the finances of many emerging markets, and many other major currencies are being pushed to new lows. Figures show that around 36 currencies worldwide have lost at least 1/10 of their value this year. This adds to pressure on emerging markets already simmering from economic malaise brought on by the pandemic. Many countries, especially poorer ones, cannot borrow in their own currencies but in dollars. When the dollar becomes stronger, borrowing costs shoots up. When the US central bank hikes interest rates, other central banks have to raise their own rates to defend their currencies. But higher rates make domestic borrowing more expensive, thus having a dampening effect on growth perspectives. This could hit government revenues, deepen poverty, incite unrest, and scare away foreign investment. Data from the Institute of International Finance recently reported that foreign investors have been pulling funds out of emerging markets for 5 straight months. That's the longest streak on record. The rate at which emerging markets are depleting their reserves of US dollars and other foreign currencies is at an all-time high. And according to the IMF, emerging and developing nations' foreign reserves have shrunk by $379 billion this year through June. These countries are collectively burning through the equivalent of more than $2 billion of foreign reserves every weekday. On the trade front, because the dollar is a dominant transaction currency in international trade, its strength can immediately impact many developing countries, especially import-oriented nations. The Fed will raise US interest rates to bring down inflation, but the higher the rates, the greater the risk that more developing economies fall into a currency crisis. This raises a wave of default risks across the world's most fragile economies. Emerging economies are bearing the burden and paying the price for the US central bank's hawkish stance, which is primarily responsible for the dollar's climb.